Property Investing Insights, your authority on all things property investing, finance and wealth creation with Right Property Group.
Hi, good everyone. How you going? Phil Tarrant here. I'm co-host of Property Investing Insights with the Right Property Group. Joined by Steve Waters, Victor Kumar. Or Victor Kumar, he should come first. He's the man of the moment. And Steve Waters, they're directors at the Right Property Group, gents.
Age before beauty.
Age before.
Oh, I walked into that one. Yeah, but I'm happy. I've got my free coffee.
Nothing's for free,
Phil.
No.
We're going to pay for that, obviously.
This friendship is not free, I tell you that for nothing. I've borne the brunt of it for well over a decade. I'm fatigued by it, personally. Fatigued. Yeah. I've given up on it all. You guys tricking me into property. Wow. You've tricked me.
I have.
A decade ago. Bought me a whole bunch of properties. Now I'm feeling the pain.
The big four-letter word, hey?
Feeling the pain. Feeling the pain. I've got to sell everything. Sell everything. I can't afford it anymore. What's going on?
Sell it all.
Sell it all. Get rid of it.
You might even make some money.
It's a myth, investing in property. Doesn't work. That's what everyone's saying.
Right. That was a good bit of acting there. I was actually starting to buy into it.
Yeah, no, it is. Obviously, it's tough. Mortgage rates and mortgage cliffs and, interest rates and inflation, and there's all these buzzwords I keep hearing in the media that tells me it's all bad. It's all bad.
Talk about set the mood.
I know.
Right?
Nothing wrong with being depressed about property. It's okay. We spoke about this last time you guys were in.
Yeah.
Did we?
We did.
Yeah. Going through cycles in terms of your love with property, love with the portfolio.
Falling in and out of love with it.
Yeah.
That doesn't necessarily mean you're depressed.
To be fair, I'm sort of I'm a fair weather property investor. I'm happy about property at the moment.
Why so?
Because I'm selling some stuff. I'm getting some cash money.
Some cash.
You don't go broke making a profit.
Mm-hmm.
You don't go broke making a profit.
What sort of profit?
Enough. I'm not telling you.
I know what it is. I'm just trying to extrapolate it from.
Yeah, I'll do
give
it.
Us a percentage.
I'll do a report.
Just give us a percentage. You can't not now.
Well, it's going to sound like a whole bunch of numbers, but the properties that we're selling have probably all they've at least doubled, if not tripled in value in a decade. So I'm getting a good check.
It's your shout.
But you're going to pay capital gains tax, Phil.
Yes, I do, but I have a good accountant.
Good.
Yeah, who because I am very strategic about investing in property, Victor, because I've listened to you for many years.
You know what? People do get hung up on selling properties because they're going to pay capital gains tax, right? Yet they have a PAYG or even self-employed. They turn up for work 2 days of the week. They're working for tax.
For demand.
Yeah.
Yeah.
And then the other 3 days is for them.
Yeah.
Property's the same, right? You're making a profit, you pay tax.
You got to pay tax.
Yeah. As little as you legally can, but pay tax.
Yeah. Someone's got to fuel this great nation, and all the money our government chooses to spend on consultants, which is a big headline at the moment. So
I'm
the
not really sure
PwC,
I'm not sure where this podcast is going. What's the subject today? What are we? Is this property or is this?
Well, it is a property podcast, Steve.
Is this the couch?
This is the counselling for Phil Tarrant.
It is. I need it.
That has been constant on a daily basis for a decade or so, but that's another podcast.
It is a podcast. Well, you got to make sure you surround yourself with the right people when it comes to property. And then you can surround yourself with the wrong people. I'm a great case study on that. But anyway, we'll move straight on from there. But we're talking about the pain in the market, Stephen. Pain in the market. A lot of people struggle at the moment. If you read the papers, but it's true.
Look, I think we can't deny the fact that there's definitely pain, within the economy. I think there are certain areas of the economy which are clearly feeling it more so than others.
Yeah.
And unfortunately, when we get to these types of rate cycles and when we have this type of environment with inflation, what it really does is it just widens that gap between those that have and those that don't.
Are you channeling your lessons in communism from year 10, are you? The haves and have-nots.
Well, I do have
flying your red flag.
I do have a communism background.
Do you? I didn't know about this. I don't know if I can talk to you.
Just through, as you just said that, the story of you telling me that you're a lord somewhere.
Laird. I'm a les, Scottish laird.
Just came into my head.
Yeah, Scottish laird.
No, just through hereditary.
Okay, that's all right. But,
Eastern Europe.
You're certainly knowing you and what you do in property in your own portfolio. I would say that you don't have a hammer and sickle hanging on a flag on your wall at home. I think you've certainly you've certainly championed all that there is about the opportunities as an Australian to invest in property for wealth creation. I think that is a good thing.
Thanks, Phil.
good
That means a lot.
But the point is, and I'm very conscious with this particular podcast, and we sort of, we're not making fun or we're not in jest of a lot of the challenges people are facing, and everyone's like everyone is getting the squeeze at some end. It's a tough market, but let's be clear: we have a new Reserve Bank governor has been announced. The first time a female into that seat, the deputy is now becoming the governor. I think that's great news. I think a lot of people are buoyed and encouraged by some new blood coming into that role, particularly at a tough time. But let's be really, really clear. Like, the government knows what it's doing right now. They know what they're doing. They've got policy setting mechanisms to shape the way in which the economy is going to behave moving forward. And we've seen interest rates go up. One of the tools to try and curb inflation. What a lot of people would say at the moment, maybe the only tool they're using to curb inflation, and maybe that's going to continue. Interest rates will continue to go up potentially. A Commonwealth Bank has come out, I think, saying, or the CEO saying, one more. And we're nearly at terminal rates, but unemployment is still a big problem. You're going to need to read the RBN notes. It's too low. The government will structurally change that. So this is the environment that we operate in. Now, what does it mean? It means a lot of people are going to do it tough. A lot of people are going to do it tough for longer.
Tougher for longer.
And it's if you talk to the government, it's a required mechanism to shape or remold the economy in a way in which they can position it to grow from again. Now, people are going to do it tough. There's a lot of pain out in the market. That said, though, if you're tuning into this particular podcast, this is not sort of Sunday morning mainstream ABC commentary. This is, we're property investors, and the three of us here, we're property investors. We invest in property for the purpose of creating wealth, and every other person, I would like to think, tunes into this podcast for the same purpose. So we need to be really clear. It's probably what no one really wants to talk about. However, smart property investors are thinking that where there is pain, there is opportunity. So let's have sensible conversations as property investors, notwithstanding the challenge a lot of Australians are facing right now. And I get that. And I come from a very humble upbringing. I've been there. I know it. But there's opportunities in this market, Victor.
Absolutely, there
and
is.
We should have a chat about that because there's opportunity there. Why wouldn't you do it?
Yeah, and I think people tend to shy away from stating the really obvious, right? And the really obvious is, yes, like Steve said, there will be some pain. And in fact, we are already seeing that out there in the market in terms of, the number of listings that are starting to come onto the market. The number of people that are starting to talk, having really serious conversations about, hang on, I really can't afford to have a vacancy because things are tight, right? And we're starting to see this trend, which is true for every cycle, where holiday homes are starting to be let go of. The investment properties are starting to be let go of. So as people consolidate to protect their nest in terms of their home, their mansion, and then they'll regroup, and those that are clued up enough or those that are versatile enough will then expand their portfolio again. So this is a cyclical thing where people do consolidate their portfolio for either good gains or to keep the rest of the portfolio safe. And they're winners and losers in this environment. And the idea is that if we don't buy into the media rhetoric of doom and gloom, the world's ending, the holding cost is going to be way too high, and if we still stuck to, first of all, what we are trying to achieve in terms of wealth creation, and as a side note, if you look at the ATO stats, majority of investors only want one property, maybe two, right? You really can't get financial freedom out of one or two properties, right? Unless they're very unique properties that have got huge cash flow, because most people are more in tune with, okay, this is how much growth my portfolio has had. So that they're not looking at both sides of the equation, cash flow or capital. And as we come into this market and we potentially start losing some value, perceived or real, right? Losing some value of our properties, and your holding cost is starting to increase, the natural tendency is for people to say, this is getting too hard. This is impacting my lifestyle. This is not what I signed up for. So let's offload.
Yeah.
Right? And therein lies the opportunity for the prepared investor who would have listened to all of the advice coming through during this changing market and being prepared to pounce on these, I would say, a gap in the market before everyone else jumps in, and making sure that we're not getting caught up in the rhetoric, we're not getting caught up in the what ifs, taking a hard, strong look at financials, cash flow, capability, the pros and cons of if it went wrong, what's my safety net, and then start investing in the select assets, in the select areas that is in line with your financial fingerprint.
So my inherent baseline, whether it's work or otherwise, mainly sort of orientated towards work, is that I operate best in hard markets. It's where I make my most focused decision making. It's where I operate with a lot more urgency, and I'm very comfortable in those sort of areas, and I thrive in those times, right? I don't like it when it's easy. I like it when it's hard, because where it's hard is when stuff actually happens. To pick up something you said connected with that, you talk about winners and losers, right? Now, is property investment binary? Is it black or white? Is it win or lose? So when you look at this market right now, and a lot of people apply the same logic to inflationary pressures, that's crippling many parts of Australia right now. There's winners and losers. Who's winning at the moment when it comes to combating inflationary pressures? Well, they always point to people who don't have a mortgage and don't rent.
Yep.
And normally bundle up as boomers who have wealth, right? They're winning because if they've got savings in bank accounts, they're getting a lot more money for it, et cetera, et cetera. They say people who are in the business of selling stuff which are inflationarily impacted are winning in the moment in the market right now, because they're able to sell stuff for a lot more. So there's winners. Who are the losers in this market? It's normally people on mortgages, and that's been really focused down to people coming off fixed rates to variable rate products, and renters who are copying it. So two-thirds of Australia at the moment are probably losing. 1/3-ish is winning. So winning and losing, right? So when you look at that, Steve, and you look at this market right now, if you talk about there's pain in the market right now, that means some people are losing, right? But there's people who can win through this. Is that the right way to view it
I think
as a construct?
the short answer is yes. And if we can bracket it up with, I guess, an ethical thought process is very, very important as well. But ultimately, there is always going to be a winner and there is always going to be a loser if you want to.
In property.
In any asset class, for that matter. Now, when we typically talk about winning and losing, it gets this emotive sort of feeling behind it, and it doesn't have to be. Winning is just succeeding. Losing is losing money.
Opportunity.
Lost opportunity, correct. Doesn't matter whether it's property or shares. So let's take Warren Buffett as an example. And you'll hear him talk about buying shares in a good company even when they're losing value. Now, when a share price is losing value, someone is losing money because the value of the share is clearly
They bought it at a
falling.
different price.
Correct. Property's no different. It's just that it's more of an emotive, I guess, asset because it's a touchy-feely, it's a necessity.
But you know what? Yes and no. I'd probably argue with you on that. I think shares is a lot more binary. So if you've bought at $100 and you sell at $80, you've lost, right? Maybe not. But property, there's a bit of greyness around it. So if you sell a property in distressed settings because you can't afford to hold it anymore, you might be selling it at less than what you would have if you held on to it. However, you're probably winning in regards to the fact that you're recalibrating your expense base, removing stress, removing, a financial environment which isn't of benefit for you. So you can get two winners in property. If people are offloading because they need to, might be a missed opportunity cost. But
that's where the emotional part of it is, right?
Component.
Because if a stock price goes down, there's usually no leverage available to it, so therefore there's not an ongoing cost. It's just profit
out,
loss.
gone, banned.
Correct, right?
Yeah.
with property, the reason people sell when in a negative environment is usually because of the cash flow position. It's not because of the equity position. It's because of the cash flow is starting to erode the household budget, and there's a physicality to that. And when there's a physicality, there's an emotional connection to it. And so when we come back to winning or losing, unfortunately, that's just life. But we can play the game, because if you don't play the game will play you. We can do it ethically. Yeah, and unfortunately, there are going to be those that are on the wrong side of the ledger. But whether it's property or whether it's shares, we're doing this for our future, as would any investor in any asset class. And sometimes there's going to be collateral.
And again, this is the inherent way in which property is structured in Australia, in that a third of Australians rent property. And that will probably grow over time purely because migrationary pressures are not building enough staff, the cost of housing. So you're always going to have this cohort of renters, generational renters, right? And they're at the whims of the property investor, who is at the whims of the market, right? So putting them aside, for property investors per se, when you consider and think about how you go about shaping wealth creation through property investment, the government is on your side. 90+% of all property in Australia for rental is by mum and dad investors. So there's a lot you can't control, but what you can control is how you play the game, how you fight the fight, the way in which you manipulate the decisions so it best suits your needs, your wants, the outcomes that you want. So the elephant in the room is that we need property investors in Australia to make a viable investment in order to provide housing for Australians. That's it. So we need more winners than losers. Fortunately, Victor, it's relatively easy to win in property in Australia unless you get it quite wrong.
That's right. So
and that's a nice safety net for all Australians because, number one, you have the government on your side. They want you to succeed. And number two, and they want you to pay taxes, right? So they win twice, if not 3 times, 4 times if you think state governments. And the bank's on your side. So you have a huge safety net to win in property.
Yep. You just need to
Which
understand,
ameliorates the pain.
It does.
Yeah.
And you just need to understand, how can you make yourself as an investor more attractive to be considered on their side, right? So I'm talking particularly in
on the
terms
right
of
side of the
banks.
ledger.
Yeah. Particularly talking in terms of banks, right? And this is one of the things that most people that aren't as strategic in their investing. And I use the word strategic very mindfully because most people, when they're investing, they're jumping into property, right? They're jumping into it, they're purchasing because they're afraid they'll miss the boat. And by doing so, they actually do miss the boat because they haven't done the pre-work to jump on the boat, right? So they've left their luggage behind in most cases. So they're now on one set of clothes for the whole cruise. Right. Whereas if you did your pre-work, you got your financial structures right. So what I mean by that is how you structure your mortgages, how you structure your ownership, how what are you aiming for, which is something that both Steve and I keep coming back to, because that's one of the most important things in property investing is what are you really aiming for, which then determines how you buy, what you buy, where you buy, and in what entity you buy. Once you've sorted that out, it becomes fairly easy to jump on board and ride the ups and downs of property investing. Property investing is never going to be a smooth sailing, if I still use the boat analogy, a smooth sailing journey, because you will have to deviate every now and then to, say, perhaps avoid a squall. You may have to weather the rougher seas as opposed to the calmer waters as such. But you could see that coming if you're well vested and you actually take a physical interest and a strategic approach towards investing. You will see those rough waters coming way ahead of time. You will see those clouds in the horizon and take the action well ahead before you've even hit that.
So you're talking about the property weather radar sitting
That's
on the
it.
bridge of the Good ship Victor Kumar sailing through smooth waters in the Pacific.
That's it.
You can see that's a metaphor for his next book, Steve.
Yeah.
Give him a little captain's hat. Yeah, maybe be a pirate.
The Titanic of investing.
Put a little parrot on his shot. But so here's the point, Steve. Is it okay, considering everything we discussed there, is it okay for property investors to make money in property investment when other people are doing it tough? Because that's the world that we live in right now.
Short answer is yes, as long as it's done ethically.
Yeah. But again, it comes back to the reason why I made the point around the construct of how renters rent property in Australia. It's incumbent on the government to make sure that those people who are struggling, we have a great welfare system here, those people that are struggling have a safety net. And I think the problem we have is that a lot of people feel as though they don't. So you have these two sides of this, which is the social, the social and community concern, and then you actually have the way in which the mechanics of property investment works in Australia, which means that Australian property investors need to make money. And it's a very, very uncomfortable relationship that a lot of people have. And you sort of frame it inside of ethical concerns. When you see families living in their car because they can't afford a house, that's not the fault of the property investor. Now, there would be certain sides of politics that would, if they had their way, they would make rent cheaper and they would block being able to increase rents. And you see a lot of people now trying to put up or stand up policy setting around this mainly out of the Greens, right? I don't know how many Greens listeners listen to this podcast. You could probably tell I'm not a Greens voter, but I'm not going to tell you where I vote because I sit comfortably in the middle of Australian politics for all those tuning in. If you were to actually put that construct in, that would stop property investors from being able to maintain and manage investment property because they need to make money out of it, which would accelerate pain. And that's a simple part of it. But are you comfortable, Steve, making money out of property personally? I'd say you would say yes. Are you comfortable helping your clients make money out of property? I would say yes.
Yes, I am, because we're a vital part of the overall economy. We're a vital part of supplying accommodation to those that potentially never want to actually own their own property or, dare I say it, be able to afford to own their own property. But let's be very clear. There are certain people, and it's well ingrained within, I believe, the Australian culture, is someone's got to take the blame. There's a lot of finger pointing that's going on from various political parties, organisation, unions, whatever it may be.
Did we just stood up a new commissioner or something, or on
who
property rent
never
or
owned
something?
I believe never owned a property.
Yeah,
never purchased
I can't remember
a property.
their name, and it's a look at housing and affordability and all this sort of stuff. I know. To Victor's point around making sure you pay your tax, but not as much as you need to, because a lot of your taxpayers go to paying for people's jobs like that who probably aren't contributing too much to the larger direction of the nation. Just saying.
Hashtag just saying. But look, there's always going to be finger pointing in any environment. Like, we don't have to go too far back, dare I say it, that during the midst of COVID, when certain, I guess, property types in certain areas, their rents were capitulating, dropping because there was no one there to rent them. Did you see these same people that are pointing the finger today having an argument back then?
Saying give them a grant to top up their rents because they're saying their rent.
Yeah. Now, I don't want to make it a them and us because it's certainly not. We've all been renters.
It's a we. We're all in it together. I genuinely believe that, right? This is the rich tapestry of property in Australia.
Look, and it's actually a fair point. Yes, we are all in it together because none of us, I don't care whether you own 0 properties or 110 properties, no one wants to see people living in tents, carts, bus shelters and doing it that tough.
Mate, you see what happens in America. I don't know if you picked up an American paper recently and see some of the issues you have in places like LA or even Santa Monica. People living tent cities popping up.
On the sidewalks, just tent after tent. That's also, you got to combine that with the drug issues and what have you, and the mental health and so on. But nobody wants to see that. I don't know of one investor, one client or not, that is rubbing their hands with a smile on their face about the crisis in and around accommodation. I don't see a one.
No.
Yeah. Well, me as an investor, I have the psyche and the thought process that I'm actually providing accommodation. I'm doing my bit, right? And by doing my bit, I'm also doing my bit for my family in increasing my wealth. So whilst you're investing, you're also helping out in terms of accommodation. We can't shy away from that, right? And this thought process of you should not increase rents, the greedy landlord. We are investing. We have got costs. We would obviously want to increase our rents, and there are in some cases in my portfolio and Steve's as well where we've elected not to raise the rent because of the circumstances of the tenant. Now that's a personal decision. But if you looked at it from a Puritan point of view, you're in there to create a return. If you were a business, which property investing is a business, then and let's say you're going to report back to the board members, or that's you, your partner, your children.
You'd be sacked as the CEO.
Exactly. Yes.
Yeah, you'd be sacked. And the point here is that property investors shouldn't take all of the downside and never realise the upside.
The upsides, yeah.
And this again is sort of balanced equation, and probably never goes in straight lines. It's up and down, it's left and right. So the rules of the game are set out by the Australian government and set out by the way in which they've created the way in which rental property works in Australia. That's the game, you know. So as a property investor, you want to participate in that game and be as fighting fit as possible, to use a sporting analogy, to be the best you can be, and that's okay. That's okay. And I'm sure everyone listening to this is going, yeah, we get that. That's why we're doing what we're doing.
Well, I'd imagine that the majority of people listening to this podcast and podcasts like it would be nodding their head going, yep, I agree with that. But then also, and we need to recognise this, there's also a big cohort that wouldn't.
No.
And that's okay.
I know where Steve Waters lives, by the way. So,
I know where you live, behind those big gates.
Yeah.
But even as I say that in jest, like behind those big gates, I remember during the GFC that one of the current affair programs did an expose on quite a wealthy landlord who owned multiple properties, and they were. Some of the people, and certainly the journalists, were behind the big gates, rattling on the gates and banging on the intercom to say, what are you going to do about us? Now that unfortunately is part of our culture here in Australia with the tall poppy syndrome and the blame game and what have you. But ultimately, if it's not us, then who is it? Who's going to supply the accommodation? The government. I'll tell you, the government
has
not.
to do it.
They won't.
If property investors don't do it, the government has to. The government can't do it, so property investors need to do it.
We can look at the data and see over the last 40 to 60 years or thereabouts that the government, federal and state, have been retreating from the idea of supplying accommodation because they can't make it viable, they can't make it work, and they can't control, I guess, the asset base and everything that goes along with property. So they've relinquished that responsibility. And to be fair, their models didn't work. And we're talking about, I guess, social housing and the like. So what they're doing today, and they're between a rock and a hard place. So they're saying, well, we kind of need accommodations. We don't want to throw our hat into the ring. We don't want to give the illusion or the ability to the retail investor to do it because that's on the nose at the moment. So what we'll do is we'll bring in big business. We'll bring in the super funds and we'll get them to, on the surface, supply this accommodation in these high-rise towers. And build to rent is what I'm referring to, which unfortunately will just end up, I believe, a lot of them as slums.
Yeah. And this is where the delineation needs to happen. That is the responsibility of the government to provide social and affordable housing, and then the role of the private landlord or institutional landlord to provide rental accommodation for the rest of Australia.
Yeah.
And that's just the way it's configured,
Because if big business takes it on and make it work, are they not going to have economies of scale? Are they not going to control the market?
Yeah.
What are you thinking about a time like this? Like, have a look say with BlackRock, I think it is one of the biggest sort of investors in the world in terms of multiple different asset classes. Yeah. If there's an inflection point in the market where demand is high and supply is low, as a business who have to report to shareholders, of course they will. They'd be ratcheting up left, right, and centre. And if they're not, they'd be incentivised not to.
Yeah, and I think the government would be, and I'd like to think, hoping they will do, incentivise to your point around creating the wrong type of assets, but they should be incentivising both. Is my point of view. They should be incentivising the Australian mum and dad investor to invest property. And let's dispel a myth, right? And I think the current government, when they had a crack at the title 8 years ago or so, or whatever it was, with when Shorten was a leader of the opposition, they got their fingers burned trying to paint this picture that property investment was the cohort of the wealthy. It's not.
It's not.
It's not. It really. Yeah, there's some outliers, right? But it's everyday Australians trying to get ahead in life, right? Because that's the way the government's constructed it, and they can see that can create wealth. It's where a lot of people have their side hustles. You know, they have their PAYG employees, and they make income there, and they try and create wealth through property. This is the way it is. But I think the government should be incentivising both institutional build to rent, and they should be incentivising mum and dad investors to do both. Because the inherent problem is that we don't have enough property in Australia at the moment for people to rent, and we're not building enough. So we're getting further behind the eight ball. So they need to accelerate building and building approvals. Again, it's back on the government to make sure they facilitate that so it's smooth and easy as possible without creating problems like, poor building standards and safety issues and all that sort of stuff. It's difficult, right? But making sure Aussies continue to provide rental stock for Australians, and they get incentivised to do that.
But it goes beyond that. Like that's the immediate benefit, if you will, of allowing the retail investor, the Mr. and Mrs., to be able to invest, is to supply accommodation. But the Mr. and Mrs. investor they're not going out there to be really brutally honest. They're not going, well, I want to do my part for society and provide accommodation. Small cohort would.
Yeah.
Ultimately, they're doing it to make money.
Yeah.
They're doing it to be hopefully a self-funded retiree, so that by the time that they've spent 45 years in the workforce, they've retired at 65 or the new age is 67, whatever it may be, that they're not one of the 80% that are reliant upon government subsidised funding
and that is
or
the
employer
point.
contributions.
And we talked about we beforehand. We all benefit from this, and I know we're sort of
a little bit biased.
We're painting a biased argument here, but the more property investors that are created who have a good journey through property investment, and at a point in time they reach a retirement phase or when they don't need to work anymore, if they do not need to suck on the teat of the government coffers for their pension, that's more money available to other Australians to support things like social housing, community housing, affordable housing, or however else the government wants to spend it. And I think the government largely gets it right. Sometimes they spend their money willy-nilly, and we see things on TV and you just go, well, what are you doing? But let's look at Australia. It's growing, right? Are we going to hit a recession? Probably, for a period of time. Maybe we might avoid it, we might not. But look back 50 years. Look back since World War II. We're done all right, even though sometimes we don't always spend our dough properly, right? Don't always get it right. We go and do some wars that we probably shouldn't fight. We spend money doing things that don't really add a lot of value to it, but we get there in the end, and that's the Australian way.
Do you know what?
See, that's the Australian way.
Australia, mate, Australia. But do you know what?
She'll be right.
As you say that, and usually it is, right? Actually,
Yeah.
She will be right, usually, over time. But the irony is that a good part of the entire world see Australia as we've done all right over time, and we always do all right. And a great example of that is, as we talked about in the midst of COVID, watch what happens when the Iron Curtain around the world is pulled up. Watch the influx of people want to move to Australia because it is the greatest country in the world and anything is possible. And have a look at the immigration numbers now. And which is contributing to the problem.
But I just saw this report the other day. 250,000 approvals for students last year coming to Australia. Just going, they'll take a photo of 1,000 students trying to rent a house and all that sort of stuff.
Yeah.
Rent. By the way, students are great people to rent your house to, because they're self-resilient and self-fulfilling in that. It's a 4-bedroom house. One leaves, one comes in, leaves, all that sort of stuff, right? You might need
until the holidays and Christmas. Then you got no one.
You might need to fix the occasional
door, window,
or when they spill their bong water on the carpet, right? but make your houses available. Make your houses available to students. Do your bit for us. Right?
Complaints to 1-800 Tarrant. Bong water. I don't even know, what is that?
I don't know. I heard about it on.
Just read it.
Yeah,
read it in Victor's book.
Read it in Victor's book.
Anyway, we digress. But I think Look, coming back to the original part of the conversation,
The pain.
in and around pain, I think we need to be brutally honest. Is there going to be pain in certain parts of the market for, I guess, segments of people? Absolutely, there is. Now, and I'm not talking necessarily about tenants and non-investors. If we quarantine it to investors, there is definitely going to be pain. The pain is already there for certain parts of the market. And we were talking about this together just before we came in on what we're seeing in the market. So if we go back to COVID, everybody wanted to be an investor. A lot of people wanted a holiday home and they wanted the principal place of residence. Now, what happens when we get times of flux within economies is that people always want to retain, they want to protect the castle, which is their principal place of residence. So everything else will go before that. What we're seeing now is that the majority, not the majority, but in some areas, the majority of stock on market is investor stock. So people are selling their investment properties. I'll get rid of the investment property to retain the principal place of residence or take the burden off cash flow. But before that, we're also starting to see, and you can see it in the data, that people are offloading the holiday homes that they've purchased during COVID and perhaps thought they'd retain that forever and ever and ever. And we can see that in the holiday-led areas that rents are falling. We can see stock on market increasing quickly. Like quick, hard and fast. And that will continue to happen until there's that balance between the household cash flow. So we've got the holiday home going, then we'll have the investment property going, and then if the worst of the worst happens, it'll then be the principal place of residence. And I believe that's why we're not seeing, these larger mortgage arrears that everybody's predicting, because we'll get rid of these assets that are sucking the life out of us.
Yeah, I spoke to someone in a quite a large mortgage organisation recently, and they said their arrears book is okay. They're not seeing it. They're not seeing it.
Yeah, we do the same.
And I think people, because they're being proactive. I think Australians, back to you could keep sort of this analogue between GFC and today. I think what the GFC taught most Australians is that they can't outsource the responsibility of their financial security to other people. I think that was a hard lesson for a lot of Australians. There was a lot of Aussies nearing retirement. They had all their dough put in share markets thinking, I'm going to have a nice, comfortable, safe retirement. And then they've got to end up working another decade because it wasn't right. And I think a lot of Australians went, you know what, I can't expect people to always be looking out for my interests. I need to look after my own. And therefore, Australians are more financially literate. And therefore, Australians are willing to make the decisions they need to make quicker because they have to.
I agree with that 100%. I believe that moment in time at the GFC was the greatest lesson for most in and around cash flow management and control, whatever that looks like to the individual. And I think the world learnt a lot from it, clearly. However, from an investing point of view, people, and we've said this before, no one lost the asset, or very few people lost an asset because of a lack of equity or growth. It was the cash flow position, I guess, in entirety that affected it.
Yeah.
And when the GFC happened, it was really, I guess, where we started to get almost terminal growth in and around technology, I believe anyway, and the internet. And we've talked about this before. And it's definitely shaped people's entrepreneurial spirit, which we've also talked about before, where they're far more educated today than what they were during the GFC.
Well, you didn't have this back in the GFC, right? You had to go to property seminars, and there's no excuse not to be informed right now. And again, this comes back to the idea is that property, if you get it wrong, can still often be a soft landing. And you're talking about people needing to offload assets primarily because of cash flow constraints, right? And being faster at making the decisions they need to make in order to buttress other parts of their lives. So it's protecting the cars, protect the family asset. And I say that by, if you've invested in property correctly, at least listening to a couple of these podcasts, you're going to be making a better decision. If you need to offload assets because of cash flow constraints, I say soft landing because you should have, if you haven't been an absolute idiot, made some smarter investment decisions. So you probably don't want to you're probably not going to end up in a negative position from what you bought the property if you've held onto it some period of time. Now, the problem is, and again, back to pain to round this out, pain is a very emotive term which is often captured and manipulated by the media to create stories. And the pain you see in this market moving forward is going to be the outliers of pain. There's not going to be the generic groundswell of pain that all Australians are experiencing right now. It is the outliers of that pain. It's going to be sensationalised. And what you will see, talking about it potentially being a soft landing in property, is that you're going to get the stories of the people who have bought at X and sold at Y quickly and have lost money as a result of it and are in dire financial straits. I would say that would be the minority of people.
Absolutely, it will be. And the reality of it is, right, that whilst APRA is steadfast in terms of its policies, whilst the Reserve Bank is still in the throes of raising interest rates, the banks are taking a commercial approach towards one aspect of the financial side of property investing, which is the refinancing side. And they're changing or making the goalposts a lot more accessible in terms of the assessment rates, the way they look at your income, the way they're looking at your repayment capability, away from the APRA-imposed buffer rates.
Yeah.
Right now, this happens in every cycle where the banks do move independently to perhaps grab market share to help their clients refinance, to continue holding on to property by actively helping them reduce their repayments. And when we talk about pain, if you're not well informed, if you're not a proactive investor, you will feel the pain because you're not exploring all of the options available to you in terms of the refinance capability. I mean, there are myriads of lenders right now that will assess you in terms of perhaps 1% above their interest rate or 1% above the cash rate. Or 2% above the cash rate. They'll take 80, 90%, even 100% of the rent into account. They'll even throw in the negative gearing to help you qualify within their books, right? They might not give you more money, but they'll help you with the cash flow.
And that's mitigating pain.
That's mitigating pain, right? So we've been talking about pain all along, and with people that are listening, whether you have a property portfolio or you don't. If you already have a property portfolio, the first thing is obviously make sure you're not on the pain part. Get rid of the pain. Be active. Be proactive. If you've talked to your mortgage broker, 6 months, 3 months ago, go back and talk to them again. Give us a call. We will put you in touch with the right people in terms of...
So you guys connected with brokers and all that stuff?
We can certainly help with investment-focused brokers.
Yep.
That's the first step, right? You need to put a platform on where you are, so that you're mitigating the biggest risk, which is a cash flow and your financial capabilities. Then the next step, obviously, is to then take advantage of the uninformed or the unprepared, and I'd say they will take advantage tongue-in-cheek, uninformed or unprepared, who then fall victim to this, right? They're not massively losing equity. It's the cash flow situation. It's the compression of lifestyle that causes them to sell. And for some, it's just the fear. They buy into the headlines, and that's why they're selling. And so for the informed investor, this is what you need to do. Prepare yourself, make sure you're not on the pain side, get yourself prepared, and then take advantage of the gap in the market where the gap really is the knowledge and the lack of action.
Just on that, Vic made a really interesting point in terms of getting in contact with your financier, your broker, whatever it may be. And the reason for that is, even though you've done that 6 months ago, even 3 months ago, and you got a no, or there was no avenues for you, whatever that may be, I would suggest that people do it on a monthly basis. Mm-hmm. And the reason for that is, if you look what's happened in the last month alone in terms of those buffer rates, where 2 of the big 4 have reduced the buffer rate from 3% to 1% on a refinance, terms and conditions, da-da-da-da-da. But what we're really talking about here is refinances only.
Yep.
We're not talking about purchases. That really hasn't changed too much. But eventually that will. And that's where the gap in the market that Vic's referring to is, that at this point in time, there's only a small segment of investors, or homeowners for that matter, that can purchase effectively, especially if you've already got an existing portfolio. And in fact, as a side note, I would say that probably the people that have the best ability, or who hold most of the cards, are the people that have either no assets and a good deposit saved, or the people that just have a principal place of residence with some equity in it and yet haven't created a portfolio because they haven't got the exposure yet.
So don't get caught up with this notion of pain and blood on the streets. There's opportunities out there. And if I was going to sort of paint a picture of what we've spoken about here, and for a lot of people it'd be sort of, a deep, dark, ugly forest with bats and looming things and, a pathway which is scary, right? But, you think of if you think of the people who are holding your hand as a property investor, it is considerable. You have a buyer's agent, you have a mortgage broker, you have you have a financial planner, but also holding hands with you is APRA. This is the mechanism of policy setting for Australian banks. You have the banks. The banks are invested in a positive outcome for you. They don't want you to go bust. They want you to keep paying your mortgage because that's how they make their money. And they want to lend you more money if you're able to afford it. You also have the government. The government has created the construct for property investors in many ways to thrive in Australia. So all of these people are on your team, and the outcome is rental stock for Australians who rent and the inherent value of property as an asset class that Australia continues to thrive and grow from. 1 in 8 Australians are somehow connected with property professionally in Australia.
I don't want to be the negative person around that that commentary. There are, however, lately an element of especially from a state level, people that just they don't want the investor to exist. Yeah, is the short of it, right? Like you look at what the Victorian government's done, Queensland.
It gets pushed down.
It does
out of the way. Sensibility, thankfully, in Australia still prevails, even though you might have moments of insanity where you just sit there shaking your head going,
but what it does
what's going on?
It all goes to the picture. It all builds part of the picture. But the people that I guess have been doing it long enough or who have given themselves adequate time to actually understand, they see through that, which goes to your point about sensibility, right? Do we all know what's around the corner? Absolutely. In terms of...
you guys reckon there's still going to be, and I'll finish with this point, a sustained period of price growth in Australian property.
Absolutely.
That's the last thing we spoke about. Go and tune into it.
Absolutely.
Whereas a lot of people say, no way in the world. You guys have painted this horrible picture. But I'd like to think the picture we've painted, we're talking sort of visual pictures, is, and your point being liquidity needs to improve in order to support that, and who knows what's going to happen in time. That inherently as an asset class, it's a good place to operate.
It always has been. Depends on how long the filter is that you put on it, right? So I believe, and that goes back to the last podcast, and I would argue that probably most advisors would agree with us, thinking that there is going to be around the corner a very decent time for the asset class. And when is that time to control the asset? Apart from when you can and if you can, the gap is there now.
So it's okay to capitalise on the gap.
Absolutely.
How do you manoeuvre into the gap to be one of those people that actually win in this market?
The first thing I would say is don't go into it with clueless enthusiasm.
Yeah.
I think you need to be strategic. You need to be
clueless
methodical.
Enthusiasm. I like it.
You like that?
Yeah.
Clueless enthusiasm. I think you need to be, as you always should, but I guess even more so now because of that, I guess the flux within the ecosystem in and around finance. You need to be strategic. You need to be methodical. You need to have a plan. You need to know what the risk involved is as well as what the upside is, and then go forth accordingly. And if it means you need to wait 1 month, 2 months, 6 months, 12 months, then so be it. But if it means that you can act now, then the best time was yesterday.
That's right. And then for those that are listening for the first time, that's what Steve and I do, right? Is we sit down with you, we map out what you can and can't do safely, and help you ask the right questions in terms of your mortgage broker, your accountants, because at the end of the day, the quality of your questions determines the quality of the advice that you'll get. So being prepared, making sure that it is safe to get started, or whether there's some pre-work still to be done, is what that conversation entails. And if you wanted to get in touch with us, and you do end up speaking with either myself or Steve directly, jump onto our website. There's a form to be filled. We will have our business manager, Kate, contact you in terms of getting the pre-work done, so that when you do have the conversation with either myself or Steve, we're not talking theory. We're talking your strategy. We're talking your circumstances and where investing could lead you, and what you need to do to get there.
There you have it. property insights with the right property group.
That was a pause for effect then. I was
like that?
I was hanging.
Property investing insights. I like it. I like talking about property with you guys. Again, it just realigns me. And, that's what you do. I still don't work out. I don't know what I do, but
We actually don't know either.
no one knows. It's really uncomfortable.
You hit the record buttons and bits and pieces.
It's a really uncomfortable conversation with people at my kids' school going, I don't know. But thanks for tuning in, everyone. And again, this is obviously a podcast for property investors where we're talking about how you can maneuver into that gap created by markets which are in flux, and that's what good property investors do. But that doesn't sort of discount the fact that a lot of Australians are doing it tough right now, and there is lots of ways and means if you are a property investor, if you find yourself in an uncomfortable position and you're not happy with how you're going right now, my recommendations would be speak to your accountant straight off the bat, get a sense for the numbers. If you know the numbers, you can start controlling the outcome you have. It's where I would start, and there's a cascade of ways in which you can look to maneuver your way through tougher markets should you find yourself in that regards. There's also a lot of help out there if you need it. Steve and Victor, thanks for tuning in, coming in, having a yarn. This is Property Investing Insights with the Right Property Group. We'll see you again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.